market participants missed any forward guidance in this current monetary policy. How do you read this? And in this slide, when do you see the rate cuts to start?
So, like we said, given the uncertainty on food price shocks, it's very difficult for central banks to sound authoritative, especially on their rate outlook. And we think RBI did the right thing by not giving any strong forward guidance, because what really happens because of that, and what's really happened in last 2 years, if you remember, when some of the central banks came out with a forward guidance that probably inflation is transitory, and because of the COVID shocks, we found that inflation was much more persistent and durable, and it's still going persistent. So probably, given that their inflation outlook depends on how monsoon pans out, on how weather patterns pan out. In fact, RBI also mentioned about the recent IMD warning of above normal temperatures in the month of April to June. Although it may not affect cereal inflation, but it may affect your vegetable price inflation, which tends to be quite volatile. If you remember last year, it is because of tomato prices that we suddenly saw a jump in inflation between the months of July to September. So probably RBI is right and more sensible not to give any forward guidance. And I think we focus as investors and market participants a lot on the timing of rate cuts. What really matters for us is what are the amount of rate cuts that we are expecting in this rate cycle. What is our investment horizon? So for investment horizon is 6 to 12 months. We should not be taking tactical bets on interest rate cuts. We should probably sticking to our risk appetite and the kind of funds that make sense from a 6 to 12 months investment horizon, which are typically money market funds. If your investment horizon is more than 12 months, and we have tolerance for mark-to-market volatility, anyways, the timing does not matter, because if we are investing from a 12 months investment horizon, and if there's an expectation that probably in this monetary policy cycle we are likely to see a 50 to 75 basis rate cuts, then anyways, given the long-term investment horizon, we don't think it should matter whether RBI does it in your 6th month of your investment or the 7th month of investment. And as we saw, in one of the slides of the Fed forward pricing, markets tend to price quite, in forward anticipation. And hence, the moment there is more certainty in the inflation outlook, probably our investors won't have to wait for the last rate cut by the RBI, to benefit from the capital gains. Probably once investors have a whiff of the rate cut cycle, the market can probably move along on those lines.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.